Sign should be a stock on your radar. The company's wholly owned subsidiary, which is focused on semiconductors, not the digital engineering business, has made an acquisition. They will be acquiring Kinetic Technologies for a stake exceeding 65% for $93 million. That is the headline. The acquired company had a top line of $41 million for this year, calendar year 2025. What the company has said is that the semiconductor business will have a revenue of about $50 million by FY27. So basically, this acquisition practically doubles the semiconductor business. The company in the Q2 conference call had also said that the semiconductor business is currently loss-making, but we will be making it EBIT neutral by FY27. In the conference call today, Cyient said the acquired acquisition will be EBIT accretive in this next year, FY26, and by FY27, year 2, it will be EPS accretive. The only thing is, JP Morgan says $93 million appears to be slightly more on the expensive side because the company will be paying an EV to revenue of 3.5 times, which is higher than the 1.92 times they had paid for the prior few acquisitions. And also, the company in the conference call has said that this funding will require some amount of debt. So part cash, but I think they went on to say that they will explore all forms of funding options, including debt for this acquisition. So that's Cyient for you. Stock is up close to about 2%. Sandip Agarwal of Sowilo Investment Managers is now joining in. Sandip, I know you've liked many of these engineering R&D sort of companies. Now, in the semiconductor business, you've got Cyient as a play. So first, share your thoughts on Cyient, what it's been doing, because it's been struggling if you look at the stock price, and then what this acquisition brings on the table.
Hi, good morning, and thanks for having me on the show. So, yeah, you see, it is not only about Cyient, but broadly all the companies have gone through massive correction in that space because the growth rate has come down a little bit and the multiples were very, very high. Now, if you see the space, I firmly believe that, the R&D space is bound to grow at 2.5 times of the IT services space, primarily because in the ER&D space, the penetration levels are 1/3 or 1/4 of the IT services space. So this space is bound to grow. And the skill set which is required in this space is even scarcer than the skill set which is available in the IT services. So obviously, this space has a much stronger moat and much stronger competitiveness for a longer time period than IT services, and hence this space will do phenomenally well for the next 10 years. But having said so, the multiples of this space have been very, very high. The PEG ratios, if you see, they run between 3 to 4 times. I believe that, the PEG ratio has to come down a little bit. And we have seen that there are a lot of acquisitions happening in the space, whether it is Cyient, whether any other company, even the IT services firms are doing a lot of acquisition to add skill sets, to add, to fill in the gaps which are there. In the space which Cyient has done an acquisition, I think that space has been doing quite good and it is a strategic step going forward. But as rightly mentioned by one of the analysts, note that, this acquisition is quite expensive if you see on the revenue basis. And also remember that the expectation of it breaking even on EBIT level next FY27 is also an expectation, and generally in large size acquisitions which we have seen in the past also, it generally takes more time, and also it is very difficult to comment because we don't know what are the exit clauses after the final payouts are made and all those things, and they have haunted Indian IT companies in the past very badly because what has happened after acquisition, a lot of key people have left. So all those things has to be seen, but yes, utilizing cash for adding skill set and filling the gaps is a very good strategy in my view. The price could be 10-15% higher or lower. No one can know that in detail.
Before we get to TCS, Sandip, very quickly, top 3 questions if we get the management of Cyient Semiconductor on this.
I think the most important question for us will be whether this is a skill set acquisition, this is a customer acquisition, kind of acquiring for getting steps in the customers, or it is a geographical acquisition. That is the most important question because that will give a lot of clarity on how this company will change, go through strategy in next 3 to 5 years. I think that is the most relevant and most important question, and it will also give you an idea what will be the margin profile in next 3 to 5 years. I believe that this space is a space where margin profile will always remain much lower than the IT services and the ER&D space. So in long term, I think from a margin perspective, it could be dilutive. So that question only the management can answer. And I think that is the most relevant question.
Okay, got that. Sandeep, now let's get to TCS. We've asked, and I'm sure you have, about quantifying, making AI as a standalone revenue line item. And they've always said that, we embed AI in every contract, whether it's cost takeout, in our productivity, internal productivity, or outcome-based contracts. But, the Investor Day, were you attending it to begin with? And what were your key takeaways? $1.5 billion in terms of AI revenue.
No, so I have not attended, but I have gone through the highlights, all the notes which have come through, and I have gone through those notes, and I understand that management for the first time has given a separate revenue for not only the AI but also the next generation business, which they are saying is at $11 billion on an annualized basis. So this is a very good disclosure, and it gives a lot of clarity to the analyst community and the investor community on projecting the future of the company, on the financials of the company. The only thing which I would like to highlight is that, the base at which the 1.5 billion is, that base is much, much bigger. And while I am very, very confident that our Indian IT services companies always will outperform the global IT services firm by 3 to 4% at least, because of the cost arbitrage and because of the mass scale capabilities we have to execute. But the only challenge which I always face in this space for last 2 years I'm struggling with is that this space, the penetration level has gone up substantially, and all the new technologies which are coming, they are coming for a very short duration and very short execution period. So what is happening, that the advantage which large caps used to have 5 years back, that all the contracts were very big size, and by default their balance sheet always qualified very few number of players for every tender, every bid, every deal. That moat has gone away post-COVID post-COVID and digital, because the sizes have gone so small that now everyone is qualified to participate in those deals. And because of that, you're seeing that for last 5 years, if you see the data, the mid and small cap have outperformed in terms of revenue growth, the large cap. And this will continue in my view, because sizes will keep on shrinking and also the execution timeline will keep on shrinking. So the balance sheet numbers which were required to participate in a deal, that is no more a requirement in my view. And that is the reason large companies will always have a revenue growth challenge.
Yes, you've been making that point, and stocks have underperformed. Very quickly, Sandeep, do you think some experts are saying that maybe there is a tactical rally which will take place in technology names? So do you have an opinion for the next 6 months? Will IT do well?
So in my view, what has happened is that most of the people, because of underperformance and all, generally people run towards performers. So everyone has cut down position in a significant way, including us. We have cut down our position 18 months back, and also the way rupee is behaving, and there is a lot of uncertainty. So there could be a hiding place which is there in IT. And remember, this is a space where the cash flow yields are very good, managements are very good, the disclosure levels are superb. So people always find a lot of comfort here. So I believe that this sector will always be a portion of the core portfolio for long-term investor, because it gives them all the benefits. It can also be treated as quasi cash or defensive, whatever you call. So I think at a price, people will come and buy, and the way rupee is behaving, I will not be surprised if there is some kind of move in the sector.
Okay, all right. Thank you very much for that, Sandeep. Good to get that perspective. Great conversation as always. And by the way, in case we don't speak again till the new year, wish you a very, very happy new year. But who knows, with IT, maybe there's more news. Maybe we'll need to call on you again. So thank you. Thank you so much for joining in.
Happy New Year to everyone, yeah.
Thank you very much. Okay, very quickly, let's just check where the pre-open has settled.